Let's move. The important point is to understand the key area that hope we already understand that part. So today, as of now, we still have almost 25 minutes. Let's the corporate tax. We can go through the part number 10, key concept of UAE corporate tax, income person tax period. So this is the main area where the corporate tax have to be, circle or rotate or move around. What is that? If there is an income, the people will pay the tax. If there is income, who will pay the tax? Who will be subject to tax and who will not be subject to tax? And on which period or on which basis he will pay the tax? These are the main or the backbone of the corporate tax calculation. Let's see the key area over here. Now, here we have to understand the corporate tax is a payable on taxable income. Corporate tax is payable on taxable income by taxable person according to tax period. In one line, we define the corporate tax. Corporate tax is payable on taxable income by taxable person. Our fight is that either our income is a taxable. The second fight is that either we are the taxable person or exempt person. So whole fight or whole the understanding or whole the complication to identify either our income is a taxable or not, taxable or exempt or out of scope, where we fall. Then the second, okay, if the income is a taxable, but are we a taxable person? According to tax period, we have to see on that also. Tax period is a 12-month accounting period as per the prescribed rate. The rate we already seen, but we'll see again. Corporate tax, I'm just summarizing here, the corporate tax having the exempt income, taxable income calculated as per the accounting rule with plus and minus adjustment. We will coming down to the main area, the main understanding. Our onward topic will be very important and the critical, and most of us are waiting for such area because that will directly you will link with the return also. Now the tax, then first we seen the income. What is our fight? We said the taxable income. We seen the taxable income and the exempt income. In our first session, we already gone through the taxable income and the exempt income also. Now the second fight is the taxable person. Who is the taxable person? We already seen some of the content or some of the important part. Now let's summarize in a more detailed version. So the person, the taxable person, we have, because taxable income, who will pay taxable person? But who is taxable person? Out of scope person are there, because out of scope they are not following under the taxable criteria. Natural person without trade license or real estate. Natural person without trade license, we already go through detail this number of time. And the real estate income, personal investment income, salaries and wages also. Next, the family foundation, which are treated as a transparent. Family foundation is part of the exempt also, but here we are mentioning the transparent. Unincorporated, not subject to tax. UIP is unincorporated partnership we are referring here. The next is the FPE, foreign permanent establishment subject to election. We will PE is standalone, is a detailed topic, an interesting topic. PE mostly the foreign company who have the branch at different means they are operating in the UAE. So we will understand in that in detail also. First, we see the out of scope. Let's see the next person is a natural person. We already today have a lot of discussion on the natural person. Natural person will be resident and non-resident. Both we mentioned they are eligible to take the natural person relief. And SBR is also available to the natural person. Now we are seeing the exempt person. In the first session, we have detailed discussion on the exempt person. Taxable person, we also go through the taxable person earlier also. Now again, we are summarizing the resident person on the worldwide income and the non-resident person on UE source income. The UE source income itself is a broader definition. And here the resident on worldwide income is also broader definition. Whatever the income he's generating from the not only UE from the worldwide, that also will be subject to corporate tax in the UE. Now earlier we seen the double tax treaty agreement. First, we have to calculate the taxable income and see if we are paying more than 9% in the foreign country, we will take the foreign tax credit and adjust over there. So we will not get refund on that, but we have to do all this exercise. And we have to see the effective corporate tax rate calculation also. Let's move to the next. Now the last we said first corporate tax is payable on taxable income by taxable person according to tax period. We already seen the detail this topic, taxable person as per accounting period, that is a 12-month, or the natural person in Gregorian calendar year, and the juridical person as per the memorandum of association or article. If limited partnership, it's already mentioned in the partnership contract. Key feature of UE corporate tax, taxable person, taxable income, tax losses, qualifying free zone. We already understand in the one by one this topic, and here is a summarized version for understanding and for revision also, because now it onward we will go into the accounting adjustment part, but that on Sunday session that we'll start on that. Taxable person, we seen the legal entity. We already seen the incorporate in UE, including free zone. Next, we see this is the new topic maybe for you. Effectively manage and control in UE. That normally we call the point. Okay, effectively manage and control in UE. What is that? Maybe your company is established in the Bahrain, but your top management, decision making, your board of directors, or the control of all the operation will be from the UE. You are resident in the UAE, or you are running the business in the Bahrain or any other part of the world, but the decision making everything from the UAE. So then that also may fall under the corporate tax. That may fall as a taxable person. That is called the POEM, or effectively manage and control in the UAE. Then next is having the P in UAE. P normally we have the different kind of the P is there. Normally, if you for a common understanding, for understanding, maybe the operating through the branch, or maybe operating through the agent, or maybe through operating a different format that we will discuss in the P detail. Here, the important part for understanding purpose, you may link if the company have the branch or they are operating from here. Okay, now the next point is the nexus. Nexus, if you have the real estate or the property in the UAE, what is that? The company, maybe in any part of the world, or the Saudi or Qatar or Oman, they having the property here, and so that may fall under nexus. But again, this is just for understanding. I'm saying what is nexus. They may have the property they give on the rental, but they may have the property they kept for investment for purpose only, capital appreciation only. But we'll see in detail what is in excess and how it's taxable, because these are the detailed topic. We have to dive one by one on that. Natural person who conduct business or business activity in the UAE, that we already seen. In tax rate for the individual and juridical person, we already knows there is a taxable income. There is a tax slab on the taxable income. First 375 is zero rated, above 375 is a 9%. This is the tax rate. Okay, this is not a registration criteria like the VAT. Still, the people in the market, they are having the penalty because they are saying we did not met the threshold. Now qualifying free zone person, the qualifying income will be zero rated, and non-qualifying will be 9%. that do not meet the qualifying income condition. We will qualifying free zone standalone is maybe 3 session, very detailed and interesting, and the people who have the interest in the free zone or working in the free zone, they will enjoy that part. Because that will be interesting and they have the valuable insight. And this is my favorite area in terms of the qualifying free zone. Small business relief could be prescribed based on the revenue that we already seen today. Now we have to see the taxable income. Okay, the taxable income, accounting profit before tax as represented in the standalone financial statement with certain adjustment. As earlier today, I shown this last statement also, we start our calculation profit before tax. Then we will see some adjustment expenses not meeting the general test wholly exclusively, that is a capital. If we already deducted, we have to add back. Okay. The next expense is not meeting the specific test, loan, interest, entertainment. So we have to see accordingly and make the adjustment, because maybe as per accounting, that expenses we already deducted, because in accounting we consider as the expense we minus, but for the tax purpose it's not expense. If it's not expense, if you already minus, you will add back. So same way, minus and plus income and loss from intra-group transfer, minus and plus transfer pricing adjustment, minus and plus unrealized gain and losses subject to election. This we seen today, the OCI. This have the correlation over here, the unrealized gain and losses, because if we are not familiar with the OCI, other comprehensive income, and applicable, and which accounting standard, that important part, which accounting standard giving the impact in the OCI. So we have to dive into that and understand exempt income, participation exemption. If you have the investment in another organization, you buy the shares, more than 5% of his shareholding are the 4 million, and if you have the intent to keep the 12 months in terms of the dividend exemption, you have to keep the 12-month intention. If you receive the dividend, that will be considered exempt. I'm talking about the foreign participation exemption. Local dividend, we already seen it exempt. Anyhow, let's see we'll go into the participation exemption. This will be one day session. Tax losses, tax loss transfer. Tax loss can be transferred between the group entity with subject to minimum 75% common shareholding. If we have the 75% common shareholding, then we can transfer the losses. Not the exempt person or the qualified person. If the person is already exempt, that he cannot take the benefit of the transfer losses. He cannot give and he can take also. The common shareholder, next is the qualifying free zone also, he will not take the benefit. Here, the next important part is same financial year or accounting period must be important. Now, the next part is the tax grouping. The tax grouping, mostly we have to give the application to the FTA before the relevant tax period. And if your tax period ending is the 31st December, before 31st December, end of 31st December 2024, you have to submit the application if you are meeting the condition. What is the condition? Parent entity hold directly or indirectly at least 95% of the share capital, plus he have the voting right, plus he have profit and net asset sharing. Okay. Have the same financial year, prepare the financial statement using the same accounting standard, and neither the parent or the company in the subsidiary is exempt or not the qualified free zone. If all these conditions are meeting, then we are eligible to take the benefit from the tax loss transfer between the group, where the common shareholding is the minimum 75%. But this in terms of the tax grouping, the minimum direct or indirect shareholding 95% plus voting right and the profit and loss. So there is a tax grouping is a different, tax loss group is a different. Please do not mix together. We have to understand separately. Tax grouping is a different concept or different understanding. Tax loss is a different understanding. Anyhow, let's move to the next. And qualifying free zone. What is the qualifying free zone? There is a certain condition they have to meet. What is the first condition? Maintain adequate substance in the UAE. Offshore companies, they will not meet the adequate substance. They will not take the benefit of the qualifying free zone. They will be subject to 9% corporate tax. Many people still maybe have the ambiguity. Offshore company will fall under the zero rated of the qualifying free zone person. No, as long as they're not able to maintain the adequate substance, so they will not take the benefit of the zero rated the corporate tax. Now, next, all the condition, it's not only one condition, all the condition on consecutively or simultaneously need to be met. Drive qualifying income. Drive qualifying income. Maintain adequate substance. What is the adequate substance? I'll just give you the example. If the company is having the business inside free zone, the trading business, so he must have the warehouse also where they will store their goods. And he have the appropriate team, like that sales team, or like the store team, like the accounts team, like the other required, the basic or the main key functional personnel must be available inside the free zone. Again, the qualifying free zone person definition is additional part that will not go into that. But this is even if the qualifying free zone person do not have adequate substance inside the free zone, so he cannot take that benefit. Now, drive qualifying income through the qualifying activity, comply with transfer pricing, not elect to city standard rate that is 9%. Anyhow, let's move to the next. Taxable income. Tax losses set off up to 75% of the taxable income for the tax period. 75% of the taxable income for the tax period. Just in the previous example, we've seen they put the limitation of the 75%. He's saying this year, whatever the taxable income, take the 75% up to that amount. Previous year losses can be adjusted, and still, if you have the losses, that you can carry forward. Remaining carry forward. Losses not eligible. Losses incurred before commencement of UAE city law, before 1st June 2023. If any losses that you cannot take the benefit. Person before a person become a taxable person. If you're not registered for the city, we cannot avail the benefit. Losses incurred from the exempt asset or the activity, we cannot utilize that. 50% ownership interest not satisfied in the same business carried out after the change in the ownership. Here, if the business is sold by one company to another company, if saying the ownership is changed more than 50%. If ownership is changed, then the previous losses cannot be utilized in the future year. This is one of the detailed topic where they put this condition as part of the GAR rule, because maybe the business who's profitable, there is another entity who's a loss making, huge losses are there. Who will buy the loss making company? Who will buy? Nobody interested. But to take the advantage of the tax, the people work on in a way, they buy such companies and they use their losses to adjust against the tax liability or taxable income. Just for understanding, but again, this is fall under the GAR rule. But the FTA or the OECD guideline, they have certain guidelines. They said it will not change 50% ownership, but there is other condition also we'll see in detail also. Transfer and the restructuring. Tax relief on intra-group transfer, maybe asset or liabilities between the intra-group. So here we will see the qualifying group 75% common shareholding. So this here we are checking the tax transfer losses. These are different, transfer and restructuring are different. Tax group is a different, tax loss transfer group are different, tax restructuring are the different. So we will understand all this. Tax transfer relief on merge spin-off, where the business is transferred in exchange of shares or other. So recently the Facebook buy the WhatsApp. So what they did, they said, okay, whoever had the previous WhatsApp shares, please, you can return the WhatsApp share and you can take the Facebook share. just Google, you may be familiar this one of the biggest, I think, this social, the high-tech technology deal, I think the last year or isn't they made. So you can understand this concept transfer and restructuring because Facebook buy the WhatsApp, and now they're saying that whoever they have the share of the WhatsApp, you can return and take the Facebook shares. And thank you guys for today's session and for your interest. Hope this session will be valuable for you guys and you keep the focus on that. Now, there is a few questions. If you have more questions, so we'll take the 5 minutes to question and answer session. Here, the one question, bad debts, written off, interest income, whether is it interest, okay, the interest income and the interest expense, together it will be called net interest. If you have the expense and income, we have to net off. And the interest capping rule is a detailed concept we will understand over there. This part, the bad debts, again, the bad debts written off, you have to follow the IFRS. As per IFRS, what are the treatment for that? And you can proceed as per the IFRS. See, now before 2023, this is the reason FTA in the first tax return, they will take the opening balances. So they will make the cutoff. Whatever the effect of the previous year, it will not affect in the future year of taxable income or taxable line items. So the FTA in the first tax return, they will ask you what is the opening balances. You have any item that may impact in the future in terms of the unrealized gain and losses and the bad debts. These are the two common examples of that. So if you want to understand that part, so we will in future down the line, we will understand in detail topic. How to apply for SBR. This is, as I already mentioned, during the first return, while you go for the return, you will, the first option will be there, your revenue. If revenue is less than 3 million, then the next option will be a pair SBR. You just tick the SBR relief. For LPF, whether every business of sole establishment person take into consideration, as we already mentioned, the sole establishment is for part of the natural person. Okay, yes. Depending on the natural person, you have to calculate all the income and you have to consolidate. Even you have 5, 10 sole establishment under the natural person, you have to consolidate all the revenue. That will be total revenue in terms of the natural relief also and in terms of sole SPR also. Any other question? Ms. Sayed, I'll make you the admin. So please take care from that. Any, there is another point. Let me. If the group of, what is this? Okay. If the group of companies having the mainland as well as qualified free zone company, then they will be considered consolidated revenue. No qualified free zone person cannot be part of the group. As I already mentioned very briefly on that, qualified free zone person cannot be part of the any group calculation. So if you want to make the group calculation and the group consolidation for the see, in terms of the accounting purpose, you can opt, but in terms of the tax we are discussing, you cannot make the consolidation for the tax purpose. Penalty above 3 million, but include the salaries. Penalty above 3 million, but include the salaries at arm's length for the director manager who are the shareholder will be allowable. This we discussed in the first session. If LLC company and they are on arm's length is the allowable expenses subject to the ALP rule. But if the natural person sole establishment, then is not deductible expenses. All this director shareholders, in terms of the natural person, such whatever the salary you pay to the owner, shareholder, director, or their connected person, it will not be deductible. But in terms of the LLC or juridical person, the juridical person have 2-3 types. Yes, it will be deductible. Will be opening bracket reversal be taxable or not? Yes, I already mentioned in the return you have to give this information. In future, it will have the impact on. Okay, guys, thank you very much for today, your participation. So we'll meet on the Sunday.